time for this week's Fiscal Focus, brought to you by InfoChoice, your choice of information on Australian consumer finance. Now, the RBA has obviously decided to hold the cash rate today, but that news has become something of a side note to the wild swings happening in the financial markets around the world at the moment, with share prices plummeting and bond prices rallying. Someone who can tell us more about this is James Austin, who's the CFO of Firstmac, one of Australia's biggest non-bank lenders. James is at the coalface of global bond markets, given that that's largely where Firstmac sources the funding for its loans. And I'm pleased to say he joins us now. G'day, James. Welcome to the Savings Tip Jar.
G'day, Dom. Thanks for having me on.
Thanks for joining us, James, in what I'm sure is a very busy day. Many of our listeners are probably more eager to hear about the whole market volatility stuff, but we'd be remiss not to mention the RBA elephant in the room. So the board elected to hold at 4.35. Just broadly, what did you sort of make of that decision?
Yeah, look, I thought it was still quite interesting in light of all of the market ructions that have happened that the RBA has a steady hand. They are looking to the persistent inflation, and whilst in the last few days there's been some calling for rate cuts far sooner, that certainly doesn't appear to be the case, and the RBA does appear to be on hold for some time.
So, James, just onto those market ructions, can you try and explain a bit of, why this is happening, and what it potentially means for interest rates on home loans and savings accounts and other financial products in Australia?
Yeah, well, it's really down to an elevated jobless print in the US, which came as something of a surprise, potentially indicating recession in the US. But rather than focusing on that one data point, it probably reflects that we've had such large interest rate increases over the past couple of years, and there's really been little fallout in the broader economy. So I think what this is now reflecting is the market saying, well, this is potentially the tipping point now. The US may well have gone into recession. Everything's been very buoyant, everything's been very calm, and the market's reacted. So we've seen some pretty major upheaval in just a few short days.
For sure. And we'll talk about Japan now. Now, you spent quite a few years in Japan, and obviously with Firstmac, sources a lot of its funding from Japan. So you're quite in touch with what's happening in the land of the rising sun. So its central bank hiked the rate to, I think, 0.25 just a few days ago. And then yesterday we saw its share market plunge. So what did you make of this? Would this be enough to stoke some fears? I mean, like, I'm sure a lot of people over the last sort of 30 years or so kind of forgot that Japan is such an economic powerhouse. But what did you make of that? And do you think maybe some former colleagues in Japan would be kind of scratching their heads at the moment?
Yeah, it was quite a dramatic move. The Nikkei fell by 13% yesterday. And much of this is due to currency movements and therefore related back to the US. So the Japanese yen is strengthening quickly now, or another way of looking at it is the US is weakening rapidly after this US recession news, or the likelihood of recession. And of course, Japan is still an export-led country. And a strengthening yen is not good news there. This is a country that's still been trying to come out of the economic burst of the 80s. So they've had 3 lost decades. They're trying to emerge out of this. This is the first time they've tried to lift interest rates, and of course it's coinciding with what's happening in the US. And it's just a quick reminder for us all of just how connected the global economy is.
Yeah, absolutely. Definitely a very globalized world we're living in at the moment. Now, bringing it back to the RBA at the moment. Now, forecasts make many fools out of economists, but I'm going to put you on the spot here, James. When do you see the first interest rate cut of this cycle happening from the RBA?
Yeah, Dom, it's interesting. And if you read through the statement that's just been issued, you wouldn't read any cut into that. In fact, reading into that statement, you'd be thinking about a rate increase, not a rate decrease. And we should remember that the Australian central bank rates have remained way below the rest of the world. So whilst other central banks elsewhere are starting to cut, we're still well below those. And the question mark is, has our cash rate been high enough to bring inflation back within the target band? Now, we know that conditions have remained pretty good in Australia. Mortgages are being paid, house prices continue to rise, and the unemployment rate remains low. So it's a fair question to say, are our cash rates high enough to bring down the inflation, which has been pretty persistent? So whilst many may be looking for a rate cut, I think that's quite a long way away.
Yeah, and if we look at the official forecast from the RBA, James, they keep pushing back that sort of midpoint inflation target by 6 months. So I recall it was around it, like I feel like it was the start of 2025, then it was mid 2025, and then it was 2026. Now it doesn't look like it's going to be till the end of 2026. Seemingly, maybe they're more comfortable with that higher inflation like rate in the name of holding on to some jobs that were made. My next question is, you mentioned that by and large people are still paying their mortgage, they're still paying their car loan. But one thing I note is that there was a report, and it's just one report, was from Pickles Auto Auctions, that showed repossessed cars going to auction through them have risen 11% over the last quarter. Are car loan delinquencies rising, and are they potentially a signal for home loans?
Yeah, it's an interesting point. So home loans have remained subdued, as I say, but and in comparison, a home loan Firstmac 0.5% are more
Wow.
than two payments missed. However, auto is up at 1%, so that's double the rate of mortgages, and a lot of that goes to the younger demographic of the car loan borrower. Um, so are they having more difficulties? You know, when these sort of events happen, it does tend to discriminate against younger, less experienced workers. So that is quite possible that you're starting to see that. But as far as long-term arrears rates and default rates, these are still very, very low, because what it tells you is, even for auto, 99% of borrowers are on time and making their payments. So those conditions are pretty good. And when you think we've had over 400 points of rate increase, it's actually surprising that it's all held up so well.
Yeah, absolutely. I mean, it would make sense that car loan delinquencies would start picking up before home delinquencies, because naturally people will cling onto their homes more than their cars, you'd think. So I wonder if car loan delinquencies picking up is somewhat of a bellwether for what's to come in the home loan market. But as you mentioned, over 400 basis points of rate rises. Now, APRA just decided last week to maintain its 3% buffer, serviceability buffer. I'm wondering, surely the odds that interest rates are going to go up another 300 basis points in the near future is very unlikely. So is it really necessary for APRA to be maintaining that 3% buffer? I mean, obviously, lenders like Firstmac don't have to abide by the APRA mandated buffer, but just give us your thoughts on that generally.
Yeah, it's very topical, because the big four bank CEOs have been pressing to have the 3% stress buffer dropped back. That their argument is that increasingly only the wealthy can have access to finance. Non-banks, of course, are not under the same regulatory scope as the banks, and the non-banks tend to have a lower servicing buffer in more recent times. So, for example, Firstmac, once the interest rate increases had been passed, we did reduce our buffer from 3% to 2%, and 2% seems to be a more realistic stress buffer. I don't think anyone would seriously think there's going to be 300 basis points of increases from here. So 2% does seem to be a more realistic number. And where rates are at now, if you are putting a 3% stress on, as the banks are, they're looking at servicing your ability to make a payment up around a 9% mortgage rate, which is pretty hefty given how large mortgages are these days. So, Firstmac, a prime lender, we're seeing very good flow, very good interest, refinance out of the banks. We're settling upwards of $600 million per month. Will the bank service rate change? The APRA governor, John Lonsdale, has twice pushed back on that this year, and quite recently, and perhaps it was last week, that he doesn't see a need for that change at this time. So those conditions look to be set to continue.
Now, James, for those already in the system, we saw that the major banks and a lot of other regional lenders lower their buffer rate for refinances of people who are in good financial standing to 1%. What is sort of Firstmac doing in this scenario, and what can non-banks do for refinances?
It's an interesting topic. Like for like refinance, it's called. It's a carve out from responsible lending guidelines, and the banks were using this practice in quite a material way up until around July last year, where APRA gave them a warning around this and reminded them that should be by exception, not the rule. Since then, the major banks have largely gone back to 3% in all cases. Firstmac applies 2% regardless of whether it's a purchase or a refinance. So we don't apply an additional like-for-like refinance approach. Some lenders do. Personally, I think it's a bit silly, because just because you've serviced a mortgage when the cash rate was 0 doesn't give any indication of how you're able to service it now that it's at 4.25%.
Yes, certainly. I suppose it always, as always, it always pays to err on the side of caution when it comes to lending, and always try and be as responsible as you can. James Austin, I'm afraid we're out of time, but thanks so much for your insights on the Savings Tip Jar podcast.
Thank you, Dom. Thank you, Harrison. Have a good day.